A lot of people were anticipating Jerome Powell's speech this week at the Jackson Hole Convention, listening, hearing, waiting for cues to see what the next steps are in the Federal Reserve's plan for monetary policy. Now, if you're not familiar as to why monetary policy is so important for the economy, we'll touch on that a little bit. We'll break down things from his speech that I pulled out to be of importance to myself, and we'll finish it off by what the other presidents in the Federal Reserve have to think about the direction that it's coming. Is it a policy mistake in the making? So if you're not familiar with what I'm talking about, I'll try my best to break this down into layman's terms to kind of give you an indication as to why everybody on the economist and stock side was watching this very closely. So if this is your first time here, my name's Nick. Welcome to Ways to Wealth. If you haven't been here before, I do have a huge favor and a huge ask. If you learn something new or you get some value out of the video, hit that like button for me. I would definitely appreciate that. And if you haven't already, please consider hitting that subscribe button and turning that notification bell on. First things first, monetary policy is the control of interest rates. So how much you would pay on a mortgage, how much you would pay on a loan. And the next part of that is how much the Federal Reserve is going to be printing and injecting into the economy. So technically, to make it as simple as possible, when the economy is hurting, the government wants to drop the interest rates and inject money into the economy. This will create cash flow, so banks will have a lot of money to loan out. It would also make buying things cheaper because money is cheap today. So if the mortgage rate drops, it's going to incentivize people to buy houses. Now, fast forward, kind of after Jerome Powell has done this, it's created inflation, and inflation is hitting super high numbers, and the highest numbers we've seen probably throughout history. Probably stagflation in the 80s was kind of the last time that we've seen numbers this high. So that's what everybody's watching. They're watching to see how long can we keep interest rates low. If they do raise interest rates, is that going to cause the economy to fall? Are people going to not be able to pay their mortgage payments? There's so many different factors. So let's just try and break down the speech, look for cues, and talk a little bit about what the next steps are. So with that being said, the strong policy support. Jerome Powell loves the fact that he was able to jump into the picture as soon as the economy started to falter in March. And he calls this his strong policy support has fueled a vigorous but uneven recovery. He'll bring up this uneven recovery a couple times. And that's the fact that the people that were able to burden the pandemic, the people that were able to work from home, that were able to roll with the punches, have done better because they've had that money coming in. They've been able to take advantage of the lower interest rates. Whereas the uneven side of it is that the people on the lower end that were laid off, the millions and millions of Americans that were laid off are the ones that are feeling the brunt, and the ones that are still yet to recover. We do see that he makes note here that the households massively shifted their spending from services to manufactured goods. This is leading to shortages of commodities and bottlenecks in the supply chain. This is kind of where the inflation conversation is coming into effect. Traditionally, the Federal Reserve likes to keep that inflation rate at 2%. I think it hit 3.7 in July. So definitely out of reach. And I guess where the concern is coming into play is how long can you leave interest rates at all-time lows? And then if that inflation number continues to increase rapidly, you may not be able to get control of it as quickly as you may think. So with that being said, the goal of the Federal Reserve is still maximum employment. The goal is to have as many people in the economy willing to work, able to work in jobs. They see now average 832 in terms of job gains. Those job gains come out, I think, every Thursday to give an indication of like who's hiring, what kind of industries it plays on that as well. So favorable conditions for job seekers should the economy cover the considerable remaining ground to reach maximum. Unemployment rate has declined to 5.4%, a post-pandemic low. So he's definitely watching employment. And then the next consideration is inflation. So over the past 12 months through July, measures of headline and core personal consumption expenditures inflation have run at 4.2 and 3.6% respectively. So a huge concern. These are relatively big numbers, seeing how inflation has been well under 2% for the past 10 years. So definitely, that along with wages, they don't want wages to increase so much. These supply shocks, in turn with the inflation, could lead to that what they consider here a wage price spiral. So I think it's been seen before. They see little evidence of it today, but it is something that is under their watch right now. They talk about longer term inflation. They mention here that it is a little bit high right now, but they're mandatory that it's just temporary swings in inflation. So they still have the transitory theory in mind, but there is a lot of evidence out there that this is a possibility of being longer term. So let's talk a little bit about what the next steps here are for the Federal Reserve. And we'll talk a little bit about the presidents in the near term. But the data here shows that the committee remains steadfast in our express commitment to support the economy for as long as is needed to achieve full recovery. Now, with this new strain coming around, they're definitely going to use that as a crux. We have said we've continued our asset purchases at the current pace. Asset purchases is them going in to buy different bonds. This puts money into the bank. This is what is considered, this money injection into the economy. Tapering is when they stop those purchases or reduce them. So they said that they're going to continue throughout. They are looking at a reduction. They are looking at increasing interest rates, and that's what everybody was like super interested in looking at. But this intervening month has brought more progress in the form of strong employment report for July, but also the further spread of the variant there. So the variant is definitely causing a step back in any decisions. So the timing and pace of the coming reduction in asset purchases will not be intended to carry a direct signal regarding the timing of the interest rate liftoff, or which we have articulated a different and substantially more stringent test. So they'll continue to hold the target range for federal funds at its current level until the economy reaches conditions consistent with maximum employment. And if the inflation has reached 2%, is on track to moderately exceed 2, we have much ground to cover to reach the maximum employment goals. They are considering at some point, first and foremost, they're going to stop injecting as much money into the economy. So that's the first goal. And then the second goal is to raise interest rates. They definitely see to taper, which means to stop spending, stop putting money in by the end of this year. But they haven't given any definitive dates. So let's take a look and take a step back and basically say there's some people that think this is a policy mistake. They should be starting to taper in October. They should be starting to get these motions in play sooner, start talking about it now. Typically, when they do bring up these conversations and they are a little bit more serious about them, it does cause the stock market to create some fearness. Money isn't as cheap for companies to grow, so growth stocks do take a little bit of a hit. So he had to be very careful in his positioning, using, certain different things and phrases as to move it along. But that wasn't the case with some of his colleagues. So he's the head of the U.S. Federal Reserve, but there's independent regions that have presidents. And we'll take a look now quickly at a few of the different presidents. First things first, Robert Kaplan, who is the Dallas Federal Reserve president, said that he's worried about inflation and risk taking and wants to announce the taper in September. Announce it, doesn't need to go through. But let's take a look at what he said. He said he's concerned about inflation and excess risk taking, and it's leading to distortions in financial markets. So essentially, the mass increase that we've seen in the S&P from that March 2020 low. Based on everything I see, I don't see anything at this point that would cause me to materially change my outlook. It doesn't care about, what variance thinks businesses can go on. We need to learn how to deal with this at some point. It would continue to be my view that when we get to the September meeting, which I think is the 22nd, we would be well served to announce a plan for adjusting purchases to begin to execute that plan in October or shortly thereafter. So definitely wants a little bit of a turn. So right now they're injecting about 120 billion a month in bond purchases, which is absolutely ludicrous when you think about it in the grand scheme of things. He says what we're seeing is businesses and consumers learning to adapt and go on with their lives. They're realizing that this isn't going to be the neat and clean or straight line, especially, in terms of the variant coming in. What we're seeing in these communities is inflation, disproportionate inflation. The housing prices have gone up. Everything's kind of run super high because of this inflation, and it's hurting more than it's helping is what Kaplan's saying. So he thinks we'll be a lot healthier if we could wean off these purchases. And then obviously the interest rate discussion isn't even there. Moving on, his colleague here, the Kansas City Fed, Esther George, was on Fox News to discuss the concerns that she's having, and it's sooner rather than later is what their concern is. So certainly the inflation numbers are coming in strong and would suggest that there's an opportunity to begin the dial back on asset purchases. We are seeing a lot of this concern coming from that's Esther right there, coming from the presidents. Some can vote, some can't vote, but obviously the fact of the matter is that they're being vocal. What is said here is there was not an intent going in to buy back mortgage-backed securities related to the housing market. I understand now that the housing market is looking frothy, backing away from those asset purchases. So explaining a little bit again about the housing market and what that's created there. But definitely, the baseline outlook is that we're going to continue to see job gains, continue to see growth. And, we don't want inflation to unfold out of control. Again, the Atlanta Fed here, by the name of Bostic, says it's reasonable to begin bond buying taper in October. This is completely different than what we were hearing from the Fed, from Jerome Powell. He was kind of dancing around this. So again, we see he's the head of the Atlanta Fed president, Raphael Bostic. He wants it to start, tapering sooner rather than later. We see here, again, the 120 number, and then the Fed could announce a plan to taper the asset purchases on September 21st to 22nd policy meeting. So maybe they're just waiting to see, and maybe that's still on track. But again, something that is definitely watched. So basically, it was surprising for me at the end of the day to see Jerome Powell. I thought personally he was going to be a little bit more firm with a plan of what's next steps, when is it going to start. He kind of tippy-toed around that, and he has his peers and his colleagues out here stating the fact that this is something that needs to be imminent, something that should start sooner rather than later. So what my concern here again is inflation. Is this a policy mistake? Should he actually be looking at it now? Is it going to run rampant? Are we going to be looking at stagflation? Stagflation is when inflation runs really high and the economy doesn't do so well. The economy's been pretty well. Earnings have been pretty good. So hopefully we don't see that happen, but it is definitely something that people are watching very, very closely. But yeah, I hope you enjoyed the video. I hope you learned a little bit about monetary policy, the Federal Reserve, what the impact is on stocks. Any questions, definitely leave them down below. But I hope you enjoyed it. I hope you have a great week in the markets. Happy trading.